The stock has done very well in the last 1 year, almost doubled. Last 3-4 years, sustainably doing well in the market. What's happening? What's the strategy you've adopted at the top level that the market has completely re-rated your company in the last 1 year, and the shareholders have a lot of confidence about the way ahead, last couple of quarters onwards?
So I think the company has taken lots of action, but at the core of it is its product, its governance, its management. And we've just strengthened our position from year on year. Today you're here at our trade show, which is something we've been doing differently for now. This is the 5th time we're doing it. And the momentum takes time to build. I think people are now getting up and noticing that Raymond is in new avatar in the market, in the sense that we're addressing it very differently. I think there's been a lot of management change. There's been an advisory board of a high quality that's been put in place, high levels of corporate governance. So the whole game has changed, and we really are positioning ourselves not for the next 2 years, but for the next 20 years. So that's what you're seeing.
So, there's a belief in the market now that, in fact, you have also communicated to a large extent to the analyst community that focus on profitability-led growth is something which you like to follow, and not just growth. What are the levers of profitability which you have, which you look forward to, press going forward, with which the profitability of the company can improve in the next coming quarter, years?
I think the first lever itself is strengthening the brand, gives a dramatic amount of price elasticity. So the moment you move from just being a category specific representation to the space of where people are ready to pay premium for the brand, actually justify the pricing for the brand, that itself is the biggest trigger for the margins to start coming in. So as we just discussed, that we've been investing heavily in the space of the brand, retail and product, we are seeing strengthening of our gross margins, strengthening of our operating margins quarter after quarter. So that's the first big lever. The second lever also is the channel mix. So we are now getting into strengthening our channel in favor of exclusive brand outlets, in favor of Raymond shops that you're seeing lately are of a completely different order. And the more we sell from there, for example, we currently are about 35 exclusive Raymond ready-to-wear shops which have an integrated made-to-measure offering. Not a single day of a year we offer any discount on our pricing. So it's 100% irrespective of end of season sale, irrespective of the end. E-commerce running about up to 80-90% of discounted stocks. Their Raymond shops do not discount. So that itself, a right channel mix itself, it does augur better for the profit margin. And the third is really scale. As our business is growing double-digit quarter on quarter, this is the 10th quarter of consistent double-digit growth on top line. Over time, this scale really amortizes the fixed costs of the company so much more better. So I think it's a combination of different buckets really coming together and all these pieces falling in place, which is really helping our profit margins to improve.
Very good point. Mr. Singhania, right, we are having this chat at a time when consumption, the perception is that consumption in the country has taken a little bit of backseat because of GST related issues. Businesses across sectors have gone in a pause mode. You're also in a consumption product for years, for decades now. One, what are your thoughts on GST as an idea and the way it's being implemented, etc., its impact on your own category and business, and the other benefits or impact of it over the longer term period on consumption?
See, firstly, you got to compliment the government for taking such a path-breaking step like GST. It is an important step to the progress of India. And anything which is out of the ordinary, which is not normal, is going to have some reaction. We cannot expect it not to have some reaction. Let's not look at short term. I think if we believe GST is good in the long term, then forget about the short term pain. Any new thing is going to cause pain. Change is going to cause pain. And there's going to be a lot of mindset of people who are going to say, chalo, India mein jugaad karke isko, let me get around it. But when they realize that jugaad nahi hota hai, you cannot get around it. It's that time period you have to wait. We're always trying to find a way. There's always going to be people who embrace change. There are always going to be people who resist change. But when change comes, everybody has to change.
Correct. Right. So you think that maybe a quarter, a couple of quarters, or FY18, half of it onwards, then things will come back to normalcy and consumption?
I think different industries it will come back faster. I think we are seeing it come back. It has to come back. I mean, people are not going to change. I mean, even a coconut tree, it swings with the change, it comes back. If you're rigid, like a tree, you'll fall and break. So people are not going to change, are going to fall by the wayside.
Right. Sanjay, analysts believe that there is scope for at least 300-400 point margin expansion over the next 4 to 8 quarters at the company level by the steps which you've indicated the top management is taking in the company. Can you explain a little more what are the specific levers which will help you increase margins over this 4 to 8 quarter period?
Yeah, so I think the specific levers are both in terms of operational efficiency. There are some capital unlocking initiatives. There are some restructuring of the kind of organization initiatives. I think all these individual buckets will lead to separate amount of operational margins going up and actually return on capital going up. And the third one is really the entire shareholder value going up there. In operational efficiencies, I've already enumerated a few reasons. There is pricing flexibility that we are seeing after strengthening of the brand there. There is a dramatic improvement in our channel mix as we go forward, and we are starting to now expand a fully franchisee-led Raymond shop models where we will be setting up about 300 shops in the next 6 quarters coming up in the tier 5, tier 6, tier 7 towns. That leads to strong double-digit growth for a brand like ours, portfolio like ours, and it is a fully franchisee-led model. So it's an asset-light model from company's perspective. So that dramatically helps us to get more control on our distribution with branded goods in the larger consumption markets there. So I think both in terms of brand strengthening, distribution expansion, some level of scale leading to cost amortization on a larger scale, larger volumes will lead to operational margins getting strengthened by about the points you made. About 200 to 300 basis point is the guidance that we have given to the investors in about 3 years' time. The second set of initiatives are actually to make the company asset light. So there are multiple initiatives that we are looking at. We're looking at leased contracts for setting up our retail capital. So we're looking at those kind of arrangements. We're also looking at unlocking the capital from our working capital by improving the efficiency of our working capital itself by renegotiating deals both with our buyers and with our suppliers. So we're looking at multiple of those initiatives to really see if we could look at some level of capital, working capital unlocking, and there is a definitive chance that we can improve at least about 10 to 15% efficiency in working capital over the next about a year, 2 years. And the third one is some capital restructuring. There are assets that we have in our group which have potential to get unlocked in 3 to 5 years' time. And if some of those come through with the chairman really blessing and actually getting engaged in some of them, we could see dramatic unlocking of value across the group. So I think there are a series of these initiatives which will help us.
In fact, one of your colleagues are telling me that you're getting extremely good response to your initiative that you're trying to go to far-flung places. Kashipur, for example, I was told that got very good response on the day one itself. What kind of store additions are you looking at, and what are the areas you're wanting to geographically expand, or some number indicative you can share?
So we currently in about 500 cities across the country. In about 3 years' time, we should cross 1,000 cities in individual cities. So we're looking at about 500 stores in totality that would come up there. I think the majority of them will happen over the next 6 to 8 quarters. So it's that's where we're upfronting our store, because we've now got a right-sized model for our store, which at a unit economics level and at a level of franchisee does have a potential to break even and give a payback in 1 to 2 years. And that's a very promising proposal that Raymond has for the entire franchising community for the country to really come and join our Raymond family and get involved in our business there. So with this model, we are confident that we can look at easily about 500 additional stores. So 1,100 store footprint can go up to about 15 to 1,600 stores in about 2 to 3 years' time.
Right. Mr. Singhania, my last question would be to you. In fact, Sanjay only indicated regarding that, and I would like to build on to that. Value unlocking at Raymond's level is something which the street has been talking about for some time now, and 3 to 5 years is what he's indicating that probably some initiatives could be taken. Would anything on the development of the surplus land which you have here in Thane and Mumbai is also one of the agenda? Because they say that the embedded value, if that also taken into account at the company level, is very huge, and it can significantly unlock value for the shareholders. Is that also an agenda? What's the timeline you have there?
See, land-related issues take time. But let me tell you on a philosophical level. Firstly, the plant was shut here because it became high cost. And obviously, the objective of the management of the company is to unlock the value from the land. We will do whatever it takes to give enhanced shareholder value. Land is such a subject, it takes more time than one can envisage, so I don't want to put any timeline on it. But let me just say, I'm also a shareholder. And the more value I unlock and the faster I do it, I am most to gain. So I'm not putting a timeline on it, but I think the company and the management will do whatever is in the best interest of the shareholder with relation to the land.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/etnow.